Wednesday, October 20th, 2021, Maneco 64, home of alternative economics and contrarian views. The reason I'm smiling is because we're seeing a lot of headlines this morning here in the UK that inflation has dipped, inflation has dropped. Wow, that's in the month where we saw shortages at the petrol stations, rising prices of everything, and we've been told that actually inflation dropped. But the headlines are misleading, of course. The other thing that I would say, it's the definition of inflation that's been corrupted. And that's why I always go on about it, because the corporate media, which is bought and paid for by the bankers, by the pharmaceutical industries, they keep fooling people about these statistics, and so does the government, of course. And I'm gonna come to that in a minute. So, for example, it says here in the Telegraph, inflation dips, but state pensions rise by 3.1% next year. So, I guess the Telegraph is upset that state pensions are rising by 3.1%. Actually, they should be rising by a lot more like 8 or 9%. But the government, of course, reneged on its deal to pensioners, the triple lock, right? Of course, it's not reneging on the bankers on anything. It's interesting that a couple of nights ago, or Monday night, the big bankers from Wall Street went for dinner with Boris Johnson, and we paid for it, right? They had a three Michelin star chef cooking for them. Bill Gates was there, of course. Bill Gates got a lot of stick trying to get into Downing Street. He had to go through the back door or side street. But so what have the bankers gotten in return from that dinner? Well, they've gotten a lot. It's just come out this morning. Sunak to cut taxes for bankers. Well, it says it's a tax surcharge on bank profits to keep Citi competitive. Well, I think it's it was what the banker said to Boris Johnson. You want your Green New Deal, which we're going to be paying for, right? And that's not me saying it. It's the Daily Mail, as you can see here. How Boris's 1 trillion green dream could hit you. Britons face more taxes, a 50% hike on their heating bills, paying $10,000 or more for a heat pump, up to $9,000 a wall for insulation, and owners of inefficient homes may struggle to get a mortgage. So we're getting that. What are the bankers getting? They're getting a tax cut. And I've spoken about this before. The bankers have gotten an exemption from the global minimum tax as well. The City of London, of course. So has inflation really dropped? Well, prices might be rising at a lower rate, but and that's all it is. But we know that inflation is the creation of money and credit out of thin air. And I've spoken to you guys about this many times, and hopefully by now you understand that inflation is the government deficit spending that they're not going to stop doing. How do you think they're going to try to finance all this corporate fascist program of the new Green New Deal? Is through more deficit spending, through more taxation of you and I. But what we had today was the CPI data that came out today, and it was expected to come out at 3.2% annualized, the annual number for September. The previous month was 3.2, and it came out at 3.1. So that's why the headlines are saying, oh, inflation dipped in September. But it's a complete and utter, really, lie, I would say. My wife was listening to talk radio, and she saw something going under. Inflation dips this in September, and she laughed. And the headlines you see here, Wales Online, inflation drops despite rise in cost of petrol and freight. So it doesn't make sense, that headline. Surrey Live, inflation drops despite rise in cost of petrol and freight. So they're using the same story there, it looks like it. But one thing I wanted to note to you, though, is that there's an old measure of prices, or inflation, that the government used to use. And when the Labour Party came into power in the mid to late 90s, Mr. Blair and Mr. Brown, they wanted to, of course, to get people spending. They wanted to borrow. That's what, well, all politicians want to borrow anyway. But they came out with a new measure of prices, and that was the CPI. The UK always used to have the RPI, but that number is still published, actually, and it came out at 4.9%. I think that's a lot better reflection of how prices are rising. Inflation, of course, is a different thing. This number will probably put a little less pressure on the Bank of England to raise rates in December, or maybe even next month. I bet you these data are gonna probably keep going lower. We'll probably get a CPI around 3% for October. And it will be an excuse for the Bank of England maybe to drag their feet a little longer. That's what I think they're trying to get at. But yeah, as you see, RPI is running at almost 5%. So I've got an article here from 2011, actually, by Marin Somerset Webb. She's the editor of Money Week, or she was at the time, and I think she still is. I used to subscribe to the Money Week in the days where you used to read magazines many moons ago. And this is what she wrote about the difference between CPI and RPI. She calls it inflation, but I would say it is CPI and RPI price indices, right? And why it matters. So let's go through this, and you see why they focus on the CPI. The Consumer Price Index, CPI, and Retail Price Index are both important indicators of inflation. Yeah, I agree with that. They're indicators of the consequence of inflation. But what is the difference, and why do they matter? So let's go through this article. I keep being asked about the difference between the Consumer Price Index and the Retail Price Index. The immediate answer is that they include slightly different things. RPI includes the costs of housing, mortgage interest costs, and council tax, for example, while CPI does not. However, it isn't that simple. If it was, we might have seen RPI fall below CPI as mortgage rates collapsed from 2008. The complicated bit and the more relevant difference between the two comes in the calculations. The RPI is an arithmetic mean, i.e. the prices of everything to be included in it are simply added up and then divided by the number of items. The CPI is a geometric mean. It is calculated by multiplying the prices of all the items together and then taking the nth root of them, where n is the number of items involved. Look on the ONS site, that's Office of National Statistics, and you see that an advantageous property of the geometric mean is that it can better reflect changes in consumer spending patterns relative to changes in the price of goods and services. So it looks like the CPI is looking more at consumer spending patterns, not at real prices, right? That may be so, but the real advantage to the government of using a geometric mean is that it is always below or equal to the arithmetic mean. So much so that the so-called formula effect tends to produce a difference of approximately 1% in the different indices. If the CPI were calculated as the RPI currently is, it would be about 1% higher than it is and higher than the RPI. This is why the government likes to link the payments it makes to pensions and other things to the CPI, and the payments it receives as taxes and so on to the RPI. So that's how they screw you. They take 4.9% from you and I, and they give us and they give us back 3.1%. That's the spread. So it's basically an arbitrage to steal your money, the CPI and the RPI, and they focus on that to say that there is no inflation. So there you go. I'm going to stop at that. Let's quickly look at where the markets are this morning. It's 8:36 a.m. London time. We've got spot gold at $17.75. That's up $6. Range has been $17.78 to $17.66. Silver is at $23.83. That's up 17 cents. Yes, the markets did well yesterday, gold and silver. They didn't hold their gains at the end of the day, but I think the price action of late has been encouraging. We're seeing higher highs and higher lows almost every day, and that is a good thing. So it looks like the trend is changing. Yeah, silver is up 0.75%, and it outperformed gold yesterday. The range this morning or overnight has been 23.95 to 23.55. To the stock market, the Dow future is up 10 points. The NASDAQ future is down 1. S&P 500 future is unchanged. The FTSE future is down 11 at 72.11. To the currencies, sterling is down about 0.1% at 137.80. The euro is down about 1/8 at 116.18. The dollar is unchanged versus the yen at 114.40. The dollar has rebounded a little bit versus the yuan, but it's still below 640. So we're near some key technical levels for the dollar. I think the dollar could drop even further versus the yuan. And why would that be happening? Well, I saw the other day that Chinese holdings of treasuries are dropping even more. So who knows what's going to happen. So as you see from this long-term chart here, we're near key technical support. Right now, though, we're at 639. It's rebounded 0.2%, the dollar versus the yuan. To the other currencies here, the Aussie dollar is up 0.1% at 74.82. The dollar is down about 1/8 versus the Canadian dollar at 123.47. And the Kiwi dollar is up 0.2% at 71.64. So let's look at the commodities, general commodities. We've got WTI crude down 0.75% at 81.77. We've got high-grade copper down about 1.2% at 461.70. So they're taking a bit of a rest. Natural gas, though, is up this morning. It's up a 1/10 at 528. And just to finish off, let's quickly look at the bond market. The 10-year yield is up just over 1 basis point. The US 10-year yield, that is, at 165. And the UK 10-year yield this morning is unchanged at 117. So there you go. If you enjoyed this video, make sure you hit the like button. Please share it far and wide. Think about subscribing to my channel if you haven't yet. And you can also follow me on Rumble, Twitter, Facebook, and all these other platforms below. I wish you all a great day. Take care. Bye.